The Netherlands has passed a 36% tax on unrealized crypto gains. Brazil has imposed a 17.5% levy on all digital asset profits, and South Korea has proposed freezing market manipulators' accounts. If you hold crypto in a high-tax country, your gains are shrinking before you ever spend them. But there's a solution. 20 livable countries currently impose zero or near zero taxes on crypto capital gains. In this video, we go through each of them. Here is what each country offers, the conditions that apply, and how to get tax residency there, and 2 countries that should come with a warning label. Let's start with the Middle East and Dubai. The UAE has no personal income tax and no capital gains tax. If you trade, stake, or mine crypto in a personal capacity, you'll likely have no tax liability. Crypto transactions have been VAT exempt since November 2024 under Cabinet Decision No. 100 of 2024, applied retroactively all the way back to January 2018. Business-level activity could trigger the 9% corporate tax, but for individual investors, it's pretty straightforward. The UAE Golden Visa grants a 10-year renewable residence permit for investors who purchase property or fund units worth at least 2 million dirham, roughly $545,000. The visa also covers immediate family members. One thing to be aware of, though, the UAE has committed to the OECD's Crypto Asset Reporting Framework, or CARF, with automatic data exchanges expected by 2028. Your crypto won't be taxed locally, but your home country's tax authority will eventually know about it. And the UAE does not offer a path to citizenship unless you're an exceptional person like Kevin O'Leary or Pavel Durov. Singapore also has no capital gains tax. Crypto gains are generally not taxable for individuals, provided the activity isn't classified as income in nature. If you trade crypto as a business, or if the Inland Revenue Authority of Singapore determines that your trading constitutes income, those profits face tax rates up to 22%. The line between personal investment and business activity comes down to frequency, intent, and the degree of organization involved. Like the UAE, Singapore has also committed to CARF, with data exchanges beginning in 2028. Residency through Singapore's Global Investor Program requires a minimum investment of 10 million Singaporean dollars, almost $8 million. A more accessible route exists through the Employment Pass, though. Citizenship is available to permanent residents on a discretionary basis, but as we've discussed extensively on this channel, Singapore does not allow dual citizenship. Monaco levies no personal income tax and no capital gains tax on residents. This applies to all asset classes, including crypto. The only exception is that French nationals living in Monaco are still subject to a French tax under a 1963 bilateral agreement. Residency via the carte de séjour requires financial self-sufficiency and local housing, typically through a bank deposit of at least €500,000, though banks may require more, plus a rental or property purchase. Monaco has no formal golden visa or path to citizenship through investment. Now, several European countries take a different approach when it comes to crypto taxes. They tax gains if you sell quickly, but exempt them entirely if you hold long enough. Germany treats crypto as private money rather than capital assets. If you hold your crypto for longer than 12 months before selling, your gains are completely tax-free regardless of the amount. Sell within that 1-year window, and short-term gains above €1,000 per year are taxed at your personal income tax rate, which can reach 45%. Mining and staking income also face income tax. The self-employment visa, under Section 21 of the Residence Act, offers a pathway to living the German dream. You need to start or invest in a business with regional economic benefit. Advisory firms typically recommend starting around €250,000 to demonstrate viability. Permanent residency is available after 3 years and citizenship after 5, and following reforms that took effect in 2024, you may hold German citizenship in a multi-passport portfolio. And of course, that citizenship grants full EU freedom of movement and residency. Portugal's tax system operates similarly. Since 2023, gains from crypto held for less than 1 year are taxed at a flat 28%. Hold longer than 12 months and your gains are entirely tax-free. Crypto-to-crypto swaps are also exempt. The D7 visa provides residency if you can demonstrate stable, passive income of at least €920 per month. Portugal's Golden Visa, restructured in 2023, now channels investments into approved funds starting at €500,000. Both routes currently lead to citizenship eligibility after 5 years, but that timeline may not last. Portugal's parliament approved amendments in October 2025 that would double the citizenship residency requirement to 10 years. Then the Constitutional Court struck down parts of the bill in December 2025, and the legislation has returned to Parliament. The current 5-year rule is still in force, but by the time you watch this video, the rules may have changed. Stay up to date on breaking news and residency and citizenship program updates like this at imidaily.com/newsletter. Okay, Luxembourg exempts crypto gains when the holding period exceeds 6 months. If you sell within 6 months, gains are treated as speculative income, taxed at progressive rates of 22 to 25%. Those speculative gains under €500 per year are exempt. This is not a dedicated crypto tax legislation. The treatment comes from a 2018 circular applying general income tax principles to crypto. As an EU member, Luxembourg offers freedom of movement across the bloc. The 6-month holding period is shorter than Germany's 12-month threshold, which makes it one of the fastest routes to tax-free gains in Europe. However, few Luxembourgish immigration routes make it difficult to move and claim tax residency. Czechia exempts crypto gains after a 3-year holding period. Under reforms that took effect in January 2025, transactions below 100,000 Czech koruna or $4,200 per year are also exempt. An annual cap of 40 million koruna, roughly $1.6 million, applies to the exemption for crypto gains, even though the equivalent cap for securities was abolished in 2026. Gains on crypto sold within 3 years are taxed at 15% or 23%, depending on income level. Czechia is an EU member with a growing blockchain ecosystem, and its Prague startup and tech scene is particularly active. Switzerland imposes no capital gains tax on crypto for individual investors. Why? The country classifies crypto as movable property, treating it much like stocks or bonds held outside a professional trading context. The catch, however, can be the wealth tax. Swiss cantons tax the total value of your assets annually, including crypto holdings, at rates that generally fall between 0.1 and 1%, depending on the canton. For the wealthy, lump sum taxation is an option. Your tax bill is based on living expenses rather than actual income. The federal minimum for lump sum arrangements is 400,000 Swiss francs per year, with cantonal floors ranging higher. Switzerland does not offer a conventional investor visa, and residency for non-EU nationals usually requires a genuine connection through employment, business, or the lump sum route. Worth mentioning, Switzerland is also joining with data exchanges beginning in 2028. Now, a different group of countries achieves zero crypto taxation through territorial tax systems. Foreign-sourced income isn't taxed at all, and crypto traded on international exchanges is generally treated as foreign-sourced. Panama's territorial tax system means income generated outside the country is not taxable. There is no capital gains tax on foreign-sourced income and no VAT on crypto transactions. Panama doesn't yet have specific crypto legislation, though new virtual asset service provider registration requirements are gradually being introduced. The qualified investor visa grants immediate permanent residency through a $300,000 investment in open market property, with higher thresholds for securities or bank deposits. The Friendly Nations visa offers a more accessible route at $200,000 for citizens of roughly 60 eligible, mostly first world countries, and citizenship is available after 5 years, contingent on Spanish proficiency. We covered in the video linked in the top right of your screen how these two visas differ and the shockingly light physical presence requirements for the QIV. Paraguay applies the same territorial principle. Individual crypto gains from activity on international exchanges are generally not taxed, There is no specific crypto tax legislation and no VAT on crypto transactions. If a transaction touches Paraguayan banks or local brokers, the tax authority may reclassify the income as locally sourced, potentially triggering income tax at 8 to 10%. But, and this is potentially a deal breaker for crypto enthusiasts, the government has just mandated wallet-level reporting for those with annual transaction levels above $5,000. At the moment, this is simply reporting, but what happens in these cases is that initial reporting leads to a taxation structure. Moving up to Central America, Costa Rica also operates a territorial tax system. If crypto activity generates local source income, standard income tax rates of up to 25% may apply, but the system relies on the general territorial principle, not a crypto-specific exemption. The Rentista visa requires stable monthly income of at least $2,500 for 2 years. An investor visa is also available for those who invest at least $150,000 in a Costa Rican business or open market property, and citizenship is available after 7 years. Costa Rica's high quality of life and established expat infrastructure make it a practical option for long-term relocation, especially for Americans and Canadians just a few hours flight north. If real estate is your preferred route, you can find eligible properties on IMI Real Estate, where we collect only listings that qualify for residency or citizenship. Hong Kong does not impose capital gains tax. Its territorial tax system means profits from crypto held as a personal investment are generally not taxable either. However, if you operate a crypto trading business, or if the Inland Revenue Department considers your trading to constitute a business, profits are subject to profits tax at 16.5%. In 2025, Hong Kong eased rules for licensed virtual assets trading platforms as part of its effort to position itself as a crypto hub. Permanent residency is available after 7 years of continuous residence, but citizenship is generally not available to foreign nationals. Now, a few countries have gone beyond passive tax treatment and actively built their regulatory environments around crypto. El Salvador adopted Bitcoin as legal tender in 2021 and has one of the most explicitly crypto-forward frameworks in the world. The country eliminated capital gains tax on certain digital asset transactions and provides favorable treatment for Bitcoin-related activity. The territorial tax system means foreign-sourced income is generally not taxed, and specific exemptions cover gains from Bitcoin transactions within the scope of the relevant laws. The Salvadoran Freedom Passport grants citizenship within a few weeks after a $1 million donation in Bitcoin or USDT, limited to 1,000 participants per year. A digital nomad visa provides 2-year renewable residency for those with a stable monthly income of about $1,500 and leads to permanent residency over time. El Salvador is a different proposition from the other countries on this list. Infrastructure is improving, but is still developing. What makes it distinctive is the depth of its commitment to crypto as national policy and safety, as it stands out from many other countries in Latin America. Georgia is one of the most favorable jurisdictions for individual crypto investors. A 2019 decision from the Ministry of Finance classifies income from cryptocurrency sales as non-Georgian source income, making it fully exempt from personal income tax. There is no capital gains tax and no VAT on crypto transactions for individuals. For companies, a 15% corporate tax applies only when profits are distributed. Reinvested earnings are not taxed. Tax residency requires spending 183 days per year in the country or qualifying through the High Net Worth Individual Program, which requires assets of at least $500,000 held in Georgia, plus a Georgian residence permit. The low cost of living and growing crypto infrastructure have made Georgia increasingly popular among digital nomads and crypto investors. Thailand has exempted capital gains from crypto transactions conducted through locally licensed exchanges, brokers or dealers through December 31, 2029. The government eliminated this tax to frame the country as another digital asset hub in a busy region, after already removing the 7% VAT on crypto gains in early 2024. The exemption is specific in scope. It applies to gains realized through licensed operators. not to all crypto activity in the country. The long-term resident visa provides a 10-year residency option, and the similar multi-tiered Thailand Privilege program requires a one-time donation as low as $25,000. Be aware, though, that Thailand does not offer a path to citizenship through any of its residency programs. If you plan around Thailand's tax break, build in a contingency for what happens after 2029. So we've just covered the countries without crypto capital gains taxes, whether they're temporary or permanent. Now let's dive into the countries that don't levy any capital gains taxes whatsoever. Malaysia does not have a general capital gains tax on most financial assets, and crypto gains for individual investors are typically not taxed. If the Malaysian tax authority determines that your trading is revenue in nature under a badges of trade analysis, those profits may be treated as business income rather than capital gains. The distinction depends on trading frequency, holding period, and degree of organization. The Malaysia My Second Home program, or MM2H, offers long-term renewable residency through a tiered system, which you'd have to do to claim tax residency anyway. Mauritius imposes no capital gains tax on individuals. Crypto gains treated as capital in nature are not taxed. If the Mauritius Revenue Authority determines that your trading is revenue in nature, standard income tax rates of 10 to 15% apply. A special 1% tax regime exists for small crypto trading businesses, plus a 2% corporate social responsibility contribution. The permanent residency permit requires a $375,000 investment in approved real estate and grants immediate permanent residency, and citizenship is available after just 2 years. The English-speaking environment and Mauritius's strong passport make it an attractive option for investors looking for a low tax base with strong institutional frameworks. Now, Malta is an interesting case. It does not impose capital gains tax on crypto held as a long-term store of value. In fact, the country recognizes crypto under its Virtual Financial Assets Act as a unit of account, medium of exchange, or store of value. Frequent or short-term trading, however, is treated as business income and taxed at a headline rate of 35%, which can be reduced to between 0 and 5% through structuring and residency arrangements. The Malta Permanent Residence Programme requires a property purchase of at least €375,000, or the more popular option, a lease of at least €14,000 per year, plus a series of government contributions and fees totaling around $130,000. For long-term holders, the combination of EU access and zero capital gains tax on investment holdings is competitive. 2 countries with a warning label. As of today, South Korea imposes no capital gains tax on crypto. A 22% tax on annual crypto gains exceeding 2.5 million won, or almost $2,000, was legislated in 2020, but has been postponed 3 times, most recently to January 2027. Researchers have warned that core deficiencies in the framework are unresolved, and a 4th delay is possible. This is a regulatory gap, not a deliberate exemption. The government has signed the CARF agreement with data exchanges scheduled for 2027, and the National Tax Service has expanded its use of blockchain analytics to track cold wallet assets. South Korea's world-class infrastructure and active crypto trading community make it attractive, but anyone relocating for tax purposes should treat the current 0% rate as temporary. Now, Turkey does not currently tax crypto capital gains either. There is no specific crypto legislation, and gains are not captured under the existing income tax framework. But comprehensive legislation is pending parliamentary approval and is expected to introduce capital gains taxes and exchange license requirements. Turkey's Citizenship by Investment program requires a $400,000 real estate investment and grants immediate citizenship. The cost of living can be low and the geographic position is strategic, but anyone choosing Turkey for crypto tax purposes should understand that legislation is actively being drafted. The current zero tax position is likely to change. If you want to stay current on these rule changes as they happen, IMI Daily covers them all. Now, before you pack your bags and cold wallets, take this into account. IMI Pro and global tax expert David L'Esperance once explained that failing to plan your departure properly can be more expensive than the taxes you are trying to avoid. So, Not only should you focus on the destination, but also how to leave your current tax residency as efficiently as possible. Of course, consult a qualified cross-border tax advisor and immigration experts before making any move. You can find all of the above on imidaily.com, where we have dedicated profiles and contact information for more than 275 experienced individuals around the globe ready to help you. Now that you know which countries won't tax your crypto, the next question is whether those same countries will tax your other foreign income. We made a video covering 29 countries that won't tax your foreign income at all, a few of which we covered today. Check it out on your screen now. This is a comprehensive encyclopedic view of the most tax-friendly countries in the world. Thanks for watching. Subscribe if you haven't done so yet.